Today we will be talking mostly about the uses of moving average applied in our analysis for the coming days. The webinar will be divided into theoretical background, which Adamos and I myself will be going through, and right after the theoretical background, which should take approximately 8 to 10 minutes, we will look into the forex market and some commodities market to see what we can expect from these tradable instruments for the coming days. Adamos, I would like to pass the floor to you to start with explaining what are the moving averages simply, and we can excel from there onwards.
So I will start from the basics, first of all. So what are the moving average are doing in reality? They are actually smoothing the price data and create a trend following indication. It's very important to have in mind that it's a lagging indicator because its calculation is based on past prices. Nevertheless, moving averages help smooth the price action, provide support and resistance, and it helps to identify the direction of the trend and give signals when used in combination. So let's see in a chart how we can apply moving averages. Let me delete these moving averages so I can help you show you how to apply them. Most likely you know, but I'm going to start from the beginning. So first of all, how I apply them, I go to the indicators, I find the moving average and then drag and drop into the chart. I will use for usually I use the 20 and 50 moving averages. It depends on what purpose I'm going to use it anyhow. So this is a 51. Okay. So first of all, for moving averages, there are a lot of calculation methods. The mostly famous is the exponential and simple calculation methods. So the simple moving average is just the average price over a specific number of periods and is mostly based on closing prices. The exponential moving averages, moving average calculation method is actually reducing the lag by applying more weight on the recent closing prices. And the main difference between the simple and the exponential moving average is that the exponential moving average is more sensitive to recent prices. However, the simple moving average represents a true average price. As we said, the exponential moving average has less lag, but the simple moving average might be a better indicator for identifying the support and the resistance level. Of course, we need to keep in mind that the longer the period we apply in the moving average, for here, for example, is 50, if we the longer the period, then the higher the lag, because we need to incorporate in the calculation more periods. So how you can use the moving average? First use, which is very famous, is the double crossover method of using the moving average. So to generate a bullish, to see a bullish crossover signal, we need to see the shorter term moving average crossing from below to above the longer term moving average. And we can find one signal like that on our current chart. So we can see one here. Let me highlight it. We can see one bullish signal here, where the shorter term moving average is crossing from below the longer term and move towards upside. Then we can see a bearish double crossover signal, which is also called death cross, where the shorter term cross from above the longer term moving average. And also the bullish one is called golden cross. However, there is some problems of the moving average signals in ranges. We can see that usually when there is a range, the moving average is useless. Okay, I move the chart. So when there is a range, we can see multiple signals of the moving average, which actually it creates the moving average to be inefficient. So we need to keep in mind that we can use them mostly when there is a trend in the market. Of course, apart from the double crossover method, we can use the moving average as a price crossover signals, and we can see that when we have a shorter term moving average again, but then we have a long term moving average applied on the chart. Let me change the period for this one. I would make it 200, so we will have a 200 moving average, and then we have also a 20 moving average. So with the 200 moving average, we can identify the current trend in the market. So we can see that prices now are below the 200 moving average. So we can conclude that the market is on a downtrend. And then when we see crossovers from above to below of the shorter term moving average, then that's a bearish signal and we can follow it. And then another method that we can use the moving average is for support and resistances. So here we can see the 20 moving average being at 1.2764. So we can conclude that the 127.64 can work as a potential support level for the prices, and 133.67 can work as a potential resistance level for the USD on the daily time frame. And the next one is the triple crossover. It's something like the double crossover, but we use one more moving average. So if I apply another one, I have the 200, and then I'm going to put the 100 moving average. So with that, I'm going to have three moving averages on the chart, and I can use them whenever the shorter term, like here, is crossing over from above to below the longer term 100 and 200 moving average. So this is a triple crossover. It's a bearish signal, and it's with some traders is considered stronger than the double crossover. So the advantages and disadvantages of the moving averages is that they are lag indicators. They are always one step behind the market, but they help identify the trend and make sure that the trader is in line with the current trend. It's ineffective in ranges, but when trend exists, moving averages will show you the way. And of course, we always use moving averages in combination with other technical tools and perhaps with fundamental confirmations. That's all that I wanted to say about the moving averages. If you have any question.
These are the theories that Adamas has just shared, but I want to also add some extra comments as well for these theories. You know, theories are written there as an idea, right? But we as traders, guys, we want to identify the theories and optimize these theories in such a way that we can take advantage of it. So the one that I'm personally myself I'm using most of the time are the 50 and 200 moving averages. If Adamas could actually change them, I always use 50 and 200 moving averages. And what I look into are two ways. I look first directly for the crossover of these two moving averages. So if 50 is passing above the 200 moving averages, I'm looking mostly into the bullish side. And if 50 is going below the 200, then I'm looking for a bearish side. But then there is a main question evolving there. How can I take advantage of it? Because as moving averages are lagging indicators, quite often, you know, you can be too late to take advantage of the trend. Well, one way is for you to look into the market with another indicator, which you can combine together in order to make a strategy. Like Adamas is using, I see the OSMA indicator, oscillator, and stochastic he is using. But you can also use in addition to that, just the moving averages as a confirmation for you. Like the way I do things is a little different. So if I'm looking at the moving averages and I want to buy, For me, I have just one requirement, and that requirement is that either both of my moving averages needs to show up sloping upwards, or one upwards, another one flat. Like you can see a number of the options there. At the moment, we have basically the 200 moving average Adamos is showing being flat, and the 50 moving average, which is the red one, is sloping downwards. It's a great indication for you to not care much about the noise in the market, but look further into the market to short. But the next question becomes, where do I short it? Not when. At the end, we cannot time scale the market, I believe, but we can price scale it. So if we are looking at the market, Adamos has a great example on his chart as an example that close to 200 moving average, we can see a crazy resistance level, which was previously a resistance level as well. So that's the zone that we should be in general looking into to short the market. Why? Well, the reason is because we have the 200 moving average, 200-day moving average, it's daily time frame, even better, is showing us that the market is into the bearish mode. It's already starting to slope southwards, downwards, and the market is well trying is most likely going to find itself a resistance at that level. And if we go into an hourly time frame, Adamos maybe could help us to go on hourly time frame. This trend can be even more straightforward, because hourly time frame, well, one day is made of 24 hours. We don't need to wait too much time for us to define the trend. So what we do basically by using this 50 and 200 moving averages, from my perspective, is that you look into the daily time frame, you look and you understand where you should be exiting the pair. I'm not looking into the daily time frame to make positioning in general, but to exit. And on hourly time frame, since it's more rapid and you can make more entries overall, I look into the market to make a position. But one thing that I always do as well on the daily time frame, if the daily is showing, let's say, bearishness, I would try to stick to bearishness. Or like in today's example, we looked into the USD Canadian dollar. We see that the market is bearish, but we also saw that it is kind of bullish towards the 200-day moving average. And on hourly time frame, now we are looking into the part that well, the market was bullish because of the shorter time frame is more responsive for the moving averages. So if Adamos, could you please go back to 1 hour time frame one more time? We can see that the both of moving averages are sloping upwards. Now we have a range trade as well, which started already on the 5th of May. And that being put together, we can expect that if the 5th of May highest high is broken, or 6th of May and the 9th of May highest high is broken above, since we are anyway expecting the pair to rise to the 200-day moving averages, we could be expecting to long the USD Canadian dollar. And from the resistance level that we talked about, we should be shorting it. We will. These are just some examples of trading moving averages. I'll go through some of the questions, and after the questions, we will look into the price developments, unless Adamos has any comments.
I'm going to discuss the USD Yen and the GBP USD.
Great. The floor is yours.
Okay, thank you. So let's start with the USD Yen. So we can see on the weekly that prices have bounced up from 18-month low at 105.49, and they went up to the downtrend line where could find upside difficulties there for the prices to move higher. Also, as we see that there is a downtrend line there, then this could be a good place to put some sell limit orders. And in addition to that, the stochastic has been making bullish divergence at the below, as we can see here, which is an extra bullish signal on the weekly time frame. On the daily time frame, we actually see the similar picture of the weekly, but more in detail. And prices have reached the downtrend line as well here, and the resistance at 109.52 is also the 61.8% of the last move down from 111.91 to 105.57. Prices are in between of the moving averages, which is confusing the picture actually here. And in addition to that, the technical picture, as we said, is not so clear, so we will need to go to the lower time frame in order to get a better idea. But also, in addition to that, I would like to mention that we can see a bullish divergence of both RSI and MACD. In the intraday time frame, first of all, let's look a bit in the fundamental developments. Last night, the Japanese GDP data were better than expected in the first quarter, and they showed an increase of 1.7%, while it was expected at 0.3% increase. Nikkei closed flat today because there is a mixed sentiment prevailing in the market. And the reason for that is that due to fasted growth data, that is reducing the chances for a Bank of Japan further stimulus. And this is actually increasing the demand on the Japanese yen. However, the higher growth supports risk appetite, and higher risk appetite takes away demand from the Japanese yen. So we have conflicting fundamental conclusions of the higher GDP data. So fundamentals are also mixed. And on the intraday, we can see that the USD yen is in a range with a strong resistance level at 109.64 and 110 resistance, psychological resistance level at 110. As we saw before on the weekly, the 110 is also a weekly resistance level. Ahead of the G7 meeting on the weekend in Japan, most likely the yen will remain in sideways. However, we may have movement from the US dollar side. As we saw yesterday, the inflation data about the US economy were better than expected. So the inflation is moving towards Federal Reserve target. Employment has been improving as well. If we don't consider the last NFP report, we can say that the employment sector has been doing good. In addition to that, we had last night Federal Reserve officials like Lockhart and Williams saying that they should consider June rate hike as a possible outcome, while the chances up to now for market participants and investors have been low, and it seems like the officials are more optimistic than the market participants for a rate hike. Eventually, the Federal Reserve official will take the decision. So on the USD yen currency pair, we will be monitoring the reaction at 110 resistance level, and if prices move higher than 110, then we are going to consider that chances for further highs are increasing. And in addition to that, the FOMC meeting minutes release later today, they are going to give a lot of clues what has happened in the previous meeting, and perhaps we might see a little bit more hawkish minutes than the last report. So on moving on the GBP USD, on the weekly time frame, we can see that the GBP USD has corrected up to the 148 resistance level, which is considered a strong resistance level given the previous bottoms there. But in the last 2 weeks, the British pound got softer and went down to the 20 simple moving average at 143.41. Stochastic has been confirming the prices up to 148. However, we can see as of this week that the stochastic is moving below his rising trend line. On the daily time frame, the GBP USD is, as we saw before, it went up to 148. So here 140 770 resistance, which is above the uptrend line. However, was not able to hold its gains above that, and it has retraced below down to the 143.28. The 143.28, as we see here, is at the 50 moving average, coupled by the 61.8% of the last move up from 140.56 to 147.71. So this 143.28 support is considered a strong support level and is likely to hold prices. However, as we can see, are mostly in range. As we said before, moving averages in ranges are not so useful. Fundamentally, we saw recently UK data haven't been supportive for the British pound. We have the Brexit concerns, and the previous week, Mark Carney said that in case of a Brexit, there is going to be upside pressure for inflation and downside pressure for growth. So the UK economy is not going to do well in case of a Brexit. Recent polls show that the results are very tight. The polls show actually that UK will remain in EU by 51% and will leave EU with a chance of 49% at the moment. So it's something that we monitor very closely, and there is a lot of fight between David Cameron and Boris Johnson. And yesterday we saw the inflation data were below expectations. Today the claimant count change was better than expected. And actually, if we go to the intraday, we can see despite the better than expected claimant count change, the prices are falling. If we go to the 1 hour chart, we can see that more clearly. The prices have reached the 144.32 support level after the release of the data, even if they have been positive. So this is an extra indication that there is a bearish bias in the GBP USD in the intraday time frame. And of course, the most important event of the day will be the FOMC meeting, and it remains to see what is going to happen at the FOMC meeting. Personally, I'm considering that after the meeting minutes release, there will be some more hawkishness in the market for the June meeting. That doesn't mean that they're going to increase the rates in June. However, the chances for a rate hike in June, they are measured by market participants at the moment at 10 to 15%, which is very low. And I believe that chances will increase after the FOMC meeting minutes. So we are likely to see a stronger dollar, and because of that, the GBP USD will move, is likely to move lower.
There is also a divergence on MACD if we look into it as well. MACD
on
is
the hourly, you mean?
Yeah, MACD is giving a higher lows, while the market is having from the other part, from the 2nd of May towards the first low that you identified. If you look at it, we have a clear divergence there.
Yes.
So that could be a signal. It's not a confirmation yet, but it could be as well a signal if we see a surprise from FOMC, I guess. But on the other side, if we look into the market as well, Adamos, I can see one strange development there, that the daily, the hourly, the 4-hour chart, all of them has failed. They all have failed to make a higher high, which is a sign that possibly the pair is likely to go on the bearish trajectory, which is quite likely. Sorry for disrupting.
No problem at all. And actually, I believe that the main driver today will be the FOMC release, despite the technicals on the fundamental side.
Well, anyway, if it was in general, whenever there is a big news like the Brexit and so on, the tradable instrument tend to trade on a side range, and this is exactly what we have for the
Yes.
I don't know how many months already, that it's just going on a quite tight range, 600
Mm-hmm.
400 pips movement. So on my side, we will look into two currency pairs, USD Canadian dollar, Euro dollar, and one commodity, which is gold. I'll look into. I'll try to make it as relevant as possible to the moving averages overall, so that you can learn maybe something out of it. So as usual, I do my analysis from top to bottom, which means I analyze the market on a higher time frame, and then I go to hourly time frame. On euro dollar, if you look into the market overall, we can see that there is there was yesterday this trend line that we could see, which has been broken below already. I was commenting that there was a symmetrical triangle, and therefore a break below 1.13 it should have brought further down movement of the pair. And at the moment we have the next support at this level overall, so 1.13 to 1.1235 level or so. But if we look into the moving averages, we can see the following. We have the 200 moving average sloping upwards, which is an indication that there is a possibility for the market to be on the bullish side, while the 50 moving average, these are daily moving averages, is kind of already staying flat. So I quite often use this funny term called a moving average sandwich. So what is a moving average sandwich? Moving average sandwich that I use in my book as well is referring to a price movement within two moving averages, like this one. So whenever moving average sandwich happens, basically one moving average pushes up, another one pushes it down, and therefore you have a side range market development, and that's called a moving average sandwich. So now that we have the moving average sandwich happening, 50 to 200 moving averages, it's likely that the pair is going to be moving between 61.8% Fibonacci retracement zone, which is 1.1140, and 88% Fibonacci retracement zone, and that's 1.1280. So these are going to be the main levels that we will be looking for. Nonetheless, if you are going to be shorting euro dollar, I believe it's a great opportunity to short it at or above 1.1280, with your stop at or above 1.1335 as well. That should be your short opportunity, while your take profit targets should be remaining at or below 1.1144 level. Moving on to hourly time frame, we can see it more clearly how important it was that break below. So whenever the trend line was broken below, we saw the continuation of the following development. Based on my analysis yesterday, if you followed A to Z Forex, you could have made around 30-40 pips, maybe even more profit with this break below order. We have this on moving average divergence convergence, which is MACD. Although the market is making a low on hourly time frame, the MACD has not yet made another low. That's a kind of a concern for me, for the fact that it's one of my key oscillators that I quite often look into. But RSI, if you're going to be looking into, is below a 50 level, which is a confirmation that the market is so far on the bearish trajectory. Also, MACD as well is below zero line, so it's another confirmation that we are on the bearish zone. So that being said, it's likely that today during an FOMC, or post FOMC, we could possibly see the pair rise towards its previous support at 1.1317 level. And from there onwards, you should be looking for short opportunities. That's for euro dollar. For gold, if you look into, this is the daily time frame. Again, 200-day moving average is sloping upwards. 20 moving average I have used here, but let me change it to 50. If we make it 50, it's kind of flattish upwards sloping. That's another point that we should look into. But if you remember the level that we have drawn previously, basically outlining the importance of 1280 and 1224 level, the pair once again has gone below the 1280 level. So that's another indication that possibly we will see a test of 1200, well, basically 1250 level, maybe 1254 level. Why do I comment that it's likely that it will be happening? So on RSI and MACD, we have the divergence happening. It is our bearish divergence. While the market made a higher high, we have had lower peaks. On hourly time frame, though, if we move into, we can see the more confirmation on the bearish side for the fact that both of our 250 moving averages are sloping downwards. Now we are kind of in a range trade, basically the range being between 1282 and 1259 level. But nonetheless, these are the following level for me, I believe, will be at 1250, 1244 level, which is the 38.2% Fibonacci retracement zone. Much depends on FOMC meeting, I repeat again, because of the fact that gold tends to appreciate and depreciate depending on the strength of the US dollar. So if you see the US dollar appreciating, of course my view will be realized on the bearish side. But on the other side, if you see the US dollar depreciating, meaning if the Fed says that no, we will, there is no rate hike at all, and we are worried about the economy and so on and so forth, we should be seeing a reversal on my view, as we have the support at 1267 level at the moment. So from there onwards, possibly we could see a reversal towards the bullish side, but we will only see it after the actual news announcement. Last thing that I want to cover today is the US dollar, Canadian dollar. Although we kind of touched into it with Adamos while we were going through the moving averages. If you look into the moving average, we have, this is the weekly time frame. We have 200 week as well as 50 week moving averages sloping upwards. The pair has bounced off the 88% Fibonacci retracement zone. And currently is finding itself a resistance at 110% Fibonacci retracement zone. On daily time frame, similar to what we have discussed a little earlier, the market says that wait a minute, on daily time frame the 200 moving average is sloping relatively downwards, staying flat, while the 50 moving average is flat as well, and we have another moving average sandwich there. So what can we expect for this pair at the moment? We can see that there is a break above the previous highest high so far. You can see it even more clearly on hourly time frame. This was the highest high that I was confirming about. So the price action is telling us that wait a minute, I'm actually on a bullish ride, and you should be concerned about your short opportunities. This is exactly what we have discussed. Moving averages are sloping upwards, so we are into a bullish mode. What you should do, you should be aiming for, or traders could be aiming for a long opportunity from here onwards, basically long from or above 1.2950 level, and the targets should be remaining, of course, initially to 1.2995, 1.30 level, which is psychological level. That's why 110% Fibonacci retracement zone is so important at the moment. But overall, the main target should remain towards a 1.35 level, which is another psychological resistance level. But possibly, though, we could see the 1.35 not achieved, and the pair could be rising only towards 1.33 level. I know 1.33 sounds funny to many people, but quite often these repeating numbers also act as a psychological resistance level for some funny reason. So we could expect the pair now rise, and then from 1.33 level, I would be cautious about my long opportunities. But Only time will show what will happen next.
It seems like we forecast the US dollar to strengthen, right?
Exactly. Well, based on the technical analysis perspective, it is what's being expected from the market. So that's likely to take place. We have one question about what do I expect about oil? The question comes from Vitatas. I made an analysis. Generally, my analysis are valid for at least 3-4 weeks. So I believe it was 2 weeks ago or so, I made an analysis that if we see a break above the 47.40 level, we will be seeing a rise towards 49.77 level. So my analysis is still valid. We have seen a break above 47.40 level, and ever since then we have a rise on oil. And before that, by the way, my analysis was commenting that if we see a 46.40 level or break above it, we will be seeing a 47.40 level. So basically, I'm just following the trend. I'm not trying to go against the trend because it's crude oil. Whenever it trends, it trends. You just need to follow it. So at the moment, try to avoid short entries. You can see on hourly time frame, both 200 and 50 moving averages are sloping upwards, and it is extremely likely that we will see the 49.77 level to be triggered, for the fact that that level is very close to 50 psychological level. And I hope you can remember what unfortunately this chart doesn't go back to the older time frames, but I hope you can remember what happened when the crude broke below the 50 level. Whenever such for crude, it's the psychological level, like 75, 50, 30 levels, 35 levels. These are extremely important levels. So whenever these levels are broken above or below, you see a rally. So we will be seeing a rally now, I hope, and I believe towards 50 level, 49.77 level, and from there onwards a reversal possibly towards back to 47.40 and even further down. One thing that many people fail to notice in the world regarding the crude oil change, but it is I believe done intentionally. Like the biggest economy in Europe is Germany, and for the last week Germany went 100% green energy. So the last week, and it went in at such a level the previous Sunday that the German electric companies started to pay its users 10 cents per kilowatt because they had so much of extra green energy that they didn't know what to do with it. So people were actually using it, and instead of going to, owing the money to the service providers, the service providers were actually deducting from their payments. Another thing that has changed in the last 1.5 months, the Netherlands, where I live right now, made an amendment to their traffic law that by 2020 or 2025, it was, I drove it, the Dutch government will not allow any car with a diesel or normal benzene to operate on the Dutch road. All the cars should be electric cars. So we see the world moving to more and more less oil dependent structure, and that's a sign that this demand is going to be falling. No matter what happens to supply, when there is no demand or the demand falls, you will see the price of the oil falling as well. But my outlook is a long-term outlook, not a short-term. There is another question called, should we be worried about the lack of momentum in the market? Well, it is silence before the storm. This is generally what happens before the FOMC meeting announcements. So, well, I guess the market is expecting to see what the Fed has actually commented about the interest rate hikes. Are they going to be having 2-3 interest rate hikes as some of the members commented yesterday? Or are they going to be commenting that they are worried and they are concerned about the world economy? That's the main commentary that you should be looking for. I know I have a contact working at one of the hedge funds now that one of their automated trading systems is designed in such a way to read or to scan the statement right away for the word concern. If they see the word concern, they will be short in US dollar. If the program is designed in such a way that if they comment that they will be hiking the interest rates, it should be long in the US dollar. Rustum comments, did we cover how come the British pound got weaker even after the good fundamental announcement? Well, I have just one comment for it. There is a clash of political power in the UK right now, and the market is quite focused on the Brexit.
We have received this warning from SISEC as well, and they wanted to warn us that on the referendum day, we need to check our exposure from clients in the market and any trading activity. So, and warn our clients about their exposure. So, yeah, it seems like everybody's taking steps to prepare itself for a possible Brexit. In addition to that, as you said, there is a clash of political powers. There is a lot of discussion in UK, and it seems like any positive news coming out from something else, they are not taken into account, and there is more strength of Brexit prevailing in everything, in the GBP USD or in any other GBP currency pair. So as we see positive data coming out and then bearish reaction, then of course this is a bearish signal, and it makes me feel more sure that bearish side will prevail for today, at least for today.
Thank you, Adamos. So this is it so far, guys. Thank you very much once again joining us. Follow our other webinars on a2zforex.com. We have amazing stuff for May. And I'll see you guys probably tomorrow myself with another webinar. Adamos, thank you very much for joining. And until next week, with you too.
Yeah, thank you too. Bye, everybody.
Bye, guys.